Hi guys, this is Sewanga from Millionaire's Journey. We are continuing with our trading course, and thank you very much for participating in this course as we try by all means to bring value in this forex journey. Okay, so on the last video we talked about analysis basics. We talked about what are analysis. We explained the types of analysis, which are technical analysis, fundamental analysis, sentiment analysis, and then we went on to explain which analysis are the best, whereby I said for you to be more accurate you need to at least try to combine two of these analysis. Try to combine technical analysis with fundamental, or technical with sentiment, or either way, as long as you can try to combine them, but I use technical analysis, and sometimes I look at the momentum using sentiment analysis. So on this video we will continue to explain more topics that will make your analysis to be more clearer. We have reversal patterns. We will talk about reversal patterns on this video. We will explain what are reversal patterns, and then we will explain the types of patterns. We have the head and shoulder, we have the inverse head and shoulder, we have double bottom, we have triple bottom and top and triple top, we have a rising, a wedge. So how to treat these patterns. We will also explain how we can capitalize on these patterns. So let's continue. So what are reversal patterns? What are reversal patterns? Reversal patterns are those chart formation that signal that ongoing trend is about to change course. So reversal patterns, they form in the chart just to warn traders that okay, this ongoing trend is about to change direction. If it was an uptrend, it's about to go down. If it was a downtrend, it's about to push up, right? So if a reversal chart pattern forms during an uptrend, it hints that the trend will reverse and that the price will head down soon. So if you see a reversal pattern on an uptrend, it means the trend is about to reverse and become a downtrend. If a reversal chart pattern is seen during a downtrend, it suggests that the price will start moving up. So if a reversal pattern is seen on a downtrend, it signals that the market is about to start pushing higher. So these are the reversal patterns: head and shoulders, inverse head and shoulders, double top and double bottom, triple top and triple bottom, and then rising and falling wedge. This can be used as or can be recognized as reversal patterns. This is the head and shoulder. We have the shoulder, we have the head, and then we have the right shoulder. This is the head and shoulder pattern, and the inverse head and shoulder pattern is the opposite of the head and shoulder. It's just this one is upside down. So head and shoulder, we have the shoulder, we have the head, and then we have another shoulder, and then we have a neckline. So the neckline is where we'll decide on our trade. And then we have a double top. A double top is one top, two top, and we can start looking for trades. And we have a double bottom, is the opposite of a double top, which means one, two, and then you can start looking for trades on the neckline. So these are basically few reversal patterns that you can look for on the chart, and you can also build a strategy on this after you take your time to practice using this pattern. So let's look at the double top, double bottom. A double top is a chart pattern where the price reaches a high twice and fails to break out during the second attempt. As you can see, this was our high. As you can see here, this was our high. Price managed to come here, it failed, pushed down, come back. So this can also be seen as resistant. It can also be seen as resistant. The pattern comprises of two peaks of nearly the same size and the bottom between them. The line running through the tops is the resistant line, which should be nearly horizontal. The price pattern forms an M, as you can see, 1, 2. So the double top forms an M. The double top forms an M. The pullback between the two highs should be moderate. This new minor support level is called neckline. This is the minor support level here. Minor support level. So this level is called the neckline. It's called the neckline. As you can see that the price came and bounced on it, so it pushed up, it came down, it pushed up, it came down to the neckline. So this is known as the neckline. The pattern is confirmed once the price breaches the low of the pullback between the two highs, also known as the neckline. So this formation 1, 2, it is only confirmed if the price closes below the neckline, like you can see here. That this confirmed that the market is going down. You can take a trade there. Now some people take trades on the second high, but it is safer to look for trades here on the break of the neckline. Double top appear in an uptrend and reverse it to a downside as price breaks through the support the neckline. So if it's an uptrend, when the price break the neckline, it's now going to a downtrend. And if it's a downtrend and the price breaks and breaks the neckline, now we have an uptrend. A double bottom chart pattern. So about that, a double bottom chart is a pattern where the price holds a low 2 times and fails to break. So a double bottom is basically the opposite of a double top. We also have a neckline, and if that neckline is broken, we start looking for trading opportunities. The pattern is characterized by a distinct drop in price, followed by a slightly reversal or bounce, with a second drop occurring soon after to either the same or similar level as the first before. So this is what it means. 1, 2. This is a double bottom. We have two almost the same lows. As you can see here. This is our double bottom. And with this pattern, we know that the price is about to change. So a double bottom is the opposite of the double top. And how can you trade this? You can trade this at the break of the neckline. But people who understand price action can even trade this here before it even gets to the neckline. The double bottom reflects a very strong level of support and often indicate a change of trend. A double bottom appears in a downtrend and reverses to the upside through the resistance line. It is considered a bullish reversal chart pattern since the price holds a low 2 times and eventually continues higher. So the price holds this low 2 times and then starts pushing up. The bounce between two lows should be moderate. The pattern is confirmed once the price reaches the high than the top of the bounce and breaks the neck. When that resistance level is broken, it is a confirmed bullish trend. And if we are on a uptrend, when the neckline is broken, we have a confirmed bearish trend. So you can go to your chart and look for these patterns and start training your eye to seeing these patterns and to learning how you can trade these patterns. That was a double top. Now let's talk about the head and shoulder. The head and shoulders is a chart pattern described by 3 peaks. The outside 2 are closed in high end, the middle is the highest. It is a bearish reversal chart pattern that begins with an uptrend with 2 highs and 2 lows, which form the left shoulder and the head. This illustrates that an upward trend is coming to an end, although the reversal is confirmed when the price drops below the neckline. The pattern is confirmed once the price breaches the neckline support. The head and shoulders chart pattern is considered by many traders and analysts to be one of the most reliable and accurate of all reversal charts. So what happens on the head and shoulders is that we have price pushing up, and then creating this level. We can call it the left shoulder, right? It pushed up, it drops here, it gives us a left shoulder, and then when it comes back, it push higher than the left shoulder, and then gives us an head, and then go back to where it started here, and then comes and give us a high, but that high is lower than the head, which confirms our right shoulder, which confirmed our other shoulder. Now, same as the double top and the double bottom, we have a neckline here. The neckline is where we can decide to enter our trade if it closes below that neckline on the head and shoulder. You don't just enter here because the price can still continue, but if the price breaks the neckline, now we can start looking for trading opportunities to the downside, as it is highly possible that the trend has changed. Now the inverse head and shoulder is the exact opposite of the head and shoulder. The price comes and gives us a low, and then on the other low it goes lower than this previous low, and then it pushes up and comes and give us a low that is equal that the shoulder, and it confirming the second shoulder. Now also you can also trade it at the break of the neckline, because this line can still be supported and push the line higher and push the price lower. But if it closes above this neckline, we can start looking for price to start going up. So that's basically the concept of head and shoulders and the inverse head and shoulders. On a downtrend, the inverse head and shoulders signals that the price will change to the upside, and on an uptrend, the head and shoulder shows us that the price can start pushing to the downside. So this is basically what the head and shoulders pattern is, and you can look for this on your chart and start practicing them. This pattern is not easy to spot because sometimes it comes with different variation. It can come like this. You need to train your eye. You need to train your eye. You need to train your eye because this pattern doesn't always come as clean as the example that I just gave you. You need to train your eye to learn how to see these patterns, to be able to understand this pattern, and with time you can master this pattern, as long as you understand that good things take time, because you cannot just learn about it today and then go to the chat and start applying it and think that you will make money. You need to practice, you need to train your eye, you need to, all these things, it takes time. You don't just start making money from these things. Let's look at the rising and the falling wedge. A rising wedge is a chart pattern formed by drawing two ascending trend lines, one representing high and one representing lows. It is categorized as a bearish reversal chart pattern, rising wedge pattern. The seeming upward trend in the price invites bullish traders to continue buying, while bearish traders continue selling off their holding, which maintain the strong upper level. Since the price refuses to break the upper level of resistance, buyers' pressure gradually decrease. The lower level of support is broken and the price break to begin a strong downtrend. The rising wedge should be taken as a strong signal and indicate that the reversal is about to start. A rising wedge is the opposite of a falling wedge. So what happens on this wedge is that you have a downtrend, right? And then price come and give you a higher low, and give you another higher low, and give you another higher low, and then eventually breaks. So when it gives you this low, you just put your lines here and they will form something like this. They will form a wedge, and this wedge can break to either sides. It can break to the downside, it can break to the upside. So at this point it was a reversal, so we have a downtrend and then it's broken and we start to have a uptrend. But on this case we had a downtrend, it came into a wedge, and then we had a continuation. So it can work as a continuation pattern and also a reversal pattern. You use trend lines to draw this, and you can just try to spot them on your chart and see how accurate these things can be. And the falling wedge is the opposite of the rising wedge. This is a rising wedge, this is a falling wedge. If your trend lines are both descending, it's a falling wedge, and if are both ascending, it's a rising wedge. So you can just look for these patterns, and if you don't understand, you can just inbox me and I will send you examples from the market, and you can start seeing this and start learning how to trade them, right? And then we have a triple top and a triple bottom explained. This is more like the bottom, the double top and the double bottom. The difference that we have price coming here 3 times. So what happens is that the price, there's a resistance, the price come touch 1, touch 2, touch 1, touch 2, touch 3. You can start selling at the break of the neckline. You can sell the break of the neckline after touch number 3. Same applies on a triple bottom. You can look for buy. So we have a downtrend, we form a double bottom and form an uptrend. Same here, we have an uptrend, form a triple top and a downtrend. So that's the concept of that's the concept of triple top and triple bottom. How to trade these patterns? To trade these chart patterns, simply place an order beyond the neckline in the direction of a new trend. Then go for a target that is almost the same height of the formation. So let's say maybe you have this double top. You can sell here and have the target that is equal this part. Let's see, your target can be here. Your target can be equal this part. For instance, if you see a double bottom, place a long order on top of the formation neckline and go for a target just as high as the distance from the neckline to the bottom. You see, so you just place an order here and then you go for a target that is same as this. In the interest of proper risk management, don't forget your stop loss. So your stop loss, it turns out because stop loss can be set around the middle of the chart. My stop loss is usually 20 pips or 30 pips, so you can also look for that. Maybe use 20 pips or 30 pips as a stop loss. For example, you can measure the distance of the top of the double bottom from the neckline, divide by 2 and use that as a stop loss. So if this was the this distance, this is the neckline, this is the top, you divide by 2 and this can be your stop loss. So you can ask for notes or you can do a research on this, because these patterns, sorry about that, because these patterns form, you can build a very solid strategy using these chart patterns. So thank you for watching up to this very end. Let's meet on the other video.